Hi everyone, welcome to this week's edition of Table Talk with Mike. This week I thought I would talk about a couple of things, and they kind of go hand in hand. Annual reviews and financial covenants that you'll have on approved financing. So starting with annual reviews, just as the name applies, it's a review done on your accounts and your financing done on an annual basis. In rare occasions, it may happen sooner than annually, but typically it's an annual process that your bank, your lender, your account manager will perform on your financing. And what they'll do is they'll collect updated financial statements from you, maybe some tax information, property tax information, a number of different items that they'll need to look at to review your financial status, where you're at financially. And that's really what an annual review is to look at where the company is at, how your most recent fiscal year went as far as your revenues, expenses, your net profits, etc. And just assessing that everything is still in a good spot. Everything's going well. They'll also be looking at your loans, your operating line, and ensuring that payments were made as agreed. There's no hiccups, no issues to be brought forward. And they do that on an annual basis. So if everything goes well with your annual review, which majority of the time it will, it's simply a matter of, okay, yep, no problem. We'll continue on how we're going and everything is good. If there are issues that pop up in your annual review though, you may find your lender asking for some changes in how you do your reporting. It could be changes in security that you've provided. It could be changes in the lending itself, the structure and how it's put together. And in some cases, though it's not super common, potentially they could ask you to find financing elsewhere and call on your loan that you have to repay it in full. But typically, generally speaking, that kind of thing doesn't happen necessarily at the annual review, because if there were issues along the way during the year, probably would have come to light and your account manager would have addressed it with you as soon as it came to light. And that's part of my video, my most recent video talking about communication, why it's so important to communicate with your account manager, with your lender, to keep them apprised of things that are going on in your business, whether it's good or bad, and addressing the issues, some of the tough challenges you might be facing, so that it isn't a surprise come annual review time and you're not asked to find financing elsewhere. Now, part of all financing is financial covenants. Even whether it's you're a small business or a larger business, it doesn't really matter. It could be a term loan or an operating line or both. Financial covenants are part of the approval process. So there are three main financial covenants that you'll find with your financing once it's approved. And there are others, but these are the main ones that across the board pretty well all institutions will have for your financing. And they're part of the review process at the end of the year. Typically, these financial covenants come into play and are reported on really only once a year. Again, it could vary depending on the financing that you have in place and how things are set up. But generally speaking, it really only comes to light at the annual review process. So those financial covenants, the first one would be a debt servicing covenant. So typically, and having been with other institutions, not just with where I am now, it's pretty much the same with every institution. From a debt servicing standpoint, they want to see a ratio of 1.25 to 1. So what that means is for every $1 in debt payment that you have every year, so the actual payments on your debt, for every dollar of that, they want to see $1.25 in net proceeds, net sales, $1.25 in actual cash that you have on hand to pay your debt servicing requirements. So it's 1.25 because it gives a cushion. It allows you to have other additional operating cash flow for your day-to-day operations and whatnot. But that's the debt servicing cash flow or debt servicing calculation. A couple of different ways that it can be put together, but that's generally the gist of how that is calculated. Another one would be debt to equity. So this would be, again, a balance sheet issue where they're looking at how much equity, how much retained earnings you leave in the company. They want to see that you're not draining the company completely and have a very low or even a negative net worth, a net equity in your company. They want to see that growing every year, and based with that they're looking at your total debt in your liability section of your balance sheet. And generally speaking, it's 3-to-1. So for every dollar of debt that is outstanding, like the actual outstanding amount on your debt, for every $3 of debt, you need $1 of equity, or vice versa. You need $1 of equity for every $3 of debt. That's the ratio. That's a typical ratio. Sometimes, depending on the industry or how it's set up or how strong you are as a borrower, it could be as high as 5-to-1. So for every dollar of retained earnings and equity in your company, you can have $5 of outstanding debt. So again, that's a ratio that is part of the annual review process. And the third one is a current ratio, which looks at, again, a balance sheet issue. It looks at your current accounts payable, what you owe to pay your bills, as well as your accounts receivable, which is the money that is owed to you. So with that one, again, they're looking minimum, they want to see 1-to-1 ratio. So for every dollar of money that has to go out to pay your bills, you have $1 of revenue coming in. That's, again, typically the ratio that they're looking for, 1-to-1 on that particular side of things. So again, those are things that you'll find when you're approved for financing. It'll be in your approval document outlining how that's all calculated. There are a couple of different ways, I said, to calculate all of them, but I'm not going to go into detail on that. The gist is what I've explained. And typically, again, those ratios are looked at once a year. Now, if you have an operating line that is margined, where you have monthly reporting, they'll be looking at that monthly. But generally speaking, those are the three main ratios that your lender will look at. And again, in specific situations, there may be additional financial covenants in play, but those are the three main ones. So hopefully you found that informative, and it kind of might shed some light on some of the reporting and why your lender is looking for that. It's just, think of it like an annual checkup, for your health. If you go for an annual physical, just to make sure everything is working well and there's no surprises. The annual review and those financial covenants is your annual checkup with your lender to make sure that the business is going well and you don't see any issues going forward based on the past year of operation. So again, if you have any questions, leave a message below, or send me a direct message and I'll get back to you directly. And yeah, have a great week. We'll talk to you later.